Hey, welcome to the Tax Pro Show. I'm glad you're here. I am Josh, the CEO of Knapp Business Solutions, with over 20 years of tax experience as an EA, and I'm going to jump into the top tax advantages for rental owners in 2026. Number one of those advantages would be depreciation. It's a non-cash expense that lets you deduct the cost of the building. You can't depreciate land. And if it's a residential rental, that's over 27 and a half years. If it's a commercial rental, you've got 39 years of depreciation. Another way of saying it is, and this is super nerdy math stuff, we take 1/27.5 on residential as the deduction, or 1/39th per year as a commercial rental. Why is that great? Well, it helps us reduce our income from that rental in that year. And the cool thing is this is still a deduction even if you're cash flow positive, right? So we don't have a loss on the rental as far as cash flow. Cash flow looked good. However, we do have a loss on the tax return because of the depreciation. A simple example of that would be you pay $275,000 for a building. That would be $10,000 a year would be the depreciation deduction. Now, one thing that we have in 2026, and we've had this for a minute, is something called a cost segregation study. And you can get a cost segregation study done on your building, and they'll break out different parts or aspects of the building, and then we can take depreciation a little bit faster. So some of it will be 5 year, some of it may be 7 year or 15 year, depending on the assets that were in the building and those components. So your 15 years are going to be things like maybe the fence or property improvements. The 5 year could be anything that would be deemed equipment, that kind of thing. Definitely, we love depreciation and we love how that works with our taxes. Number two on this list is going to be your deductible operating expenses. I would say everything ordinary and necessary is going to be a deduction that you can take, and that's also going to reduce your taxable income, and it's going to be awesome. So some examples of this might be like property management fees, repairs and maintenance, potentially your mortgage interest if you got a loan on the property, your property taxes, your insurance, advertising, utilities, assuming you pay them, any HOA fees, repairs, and so on. One thing that people do miss is keeping up with their mileage. So if you're driving to and from that rental property to manage it, you want to track that because that's also deductible. That takes us to number three, which would be pass-through deduction, or QBID, qualified business income deduction. So if your rental activity qualifies as a trade or business, you can deduct up to 20% of your net rental income from your taxes, which is pretty cool. Definitely one of those things that we like. Now, this gets a little bit tricky, and to qualify for that one, you've got to keep up with your bookkeeping. So bookkeeping is important. You want to keep up those records, and then you got to spend some time actually actively working on that rental, right? Greater than $250,000 a year. You want to make sure you're tracking all of that, and you can prove that you're spending that much time on it to make it a business. Number four, mortgage interest. This one is obviously something I would hope that you don't have, and hopefully you're paying cash for those rentals. But if you do have mortgage interest, then we're definitely going to take those as a deduction. The great news is this is not an itemized expense on that rental. Like a personal home loan, this goes directly on your Schedule E as a deduction.
Unlock the power of full-service payroll with Payority. What is full-service payroll? It's the ultimate hassle-free solution for managing your business's payroll needs. With full-service payroll, every aspect of payroll processing is handled for you, from calculating wages and taxes to filing compliance reports and ensuring timely payments. You get peace of mind while saving time and resources. Why Payority's full-service payroll stands out. Complete payroll management. We handle everything: wage calculations, tax withholdings, direct deposits, and more. Compliance made easy. Stay worry-free with expert handling of federal, state, and local tax regulations. Employee self-service. Empower your team with easy access to pay stubs and tax forms through our secure portal. Dedicated support. Our payroll experts are with you every step of the way, ensuring accuracy and reliability. Ready to simplify your payroll? Visit Payority.com to learn how our full-service payroll solutions can transform your business.
And that takes us to number five. This one's kind of cool. So, Code Section 1031 has been around for a minute, and it's been adapted and changed over the years. One of the only things we can still use 1031 for is real property, real estate property, right? So what this does is, let's say your basis, you bought a property, $27,000, you've owned it for 27 years, you've depreciated it fully, so your tax basis is $0 in that property, and you want to buy another property. You can do a 1031 where you sell it, the proceeds go to an attorney, they hold it for you, you buy another property with those funds, and you just like-kind exchange it. You're swapping it out, and you're not going to pay taxes. So that's kind of cool. Definitely something to keep in mind, and we use it quite a bit. Number 6, obviously those capital gain rates. So if you sell the property that you've been holding for more than 1 year, you're going to pay long-term capital gains on that. Anything you depreciate is going to recapture under 1250, which basically just means you pay ordinary income tax up to 25%, depending on what bracket you're in. Of course, gain exclusion can apply. So if you lived in that home 2 of the last 5 years, then any gain, capital gain, may be excluded, and that's something that I like to keep in mind. All right, that brings us to number 7. Passive loss rules. So this is a big one, right? We want to make sure that we're aware of those passive loss rules. We want to make sure we're not going to have any kind of issue. There are some limits around this, and this gets obviously a lot more complex. You can deduct up to $25,000 against your ordinary income if you actively participate and your income is below $150,000. So we want to be aware of those passive loss rules. A lot of times what can happen is we've got a loss and we're carrying that loss over because our income's too high, and we don't get to recognize it until we sell the property. So it's not like it's gone forever. It's like a savings account for that rental property where when you sell it, you're going to get to take the loss then. So definitely something to be aware of with the tax planning side. That takes us to number 8, which is going to be real estate tax professional status. This one is a big deal, right? Huge tax advantage if you qualify. If you or your spouse can qualify for an REP, then those losses become fully deductible against ordinary income, and there's no passive limits. The trick is you've got to prove that you're working on that property 750 hours plus. This one is another one that's very important that you've got to prove, and it's a little bit tricky to prove this, but you got to kind of show that, hey, we're really working this to be really our full-time income. Like, we are truly trying to have only rental income as our full-time income, kind of unlock that potential deduction. So more than half of your working time in real estate, and it's pretty awesome. I've definitely had clients qualified for that because they're spending a lot of time on those rentals. And if they do have those losses, then that unlocks it where we can deduct it. And that takes us to number 9, deducting travel and home office expense, right? The travel that's ordinary and necessary, going to that rental property and taking care of things, driving back and forth. This is where we have a written log. If you're going to meet a contractor, you're going to collect rent, whatever you're doing, going to purchase supplies, or even just going to deposit the rent check. Those are miles you want to include in your log. And obviously something that we want to be aware of. The other thing would be home office expense. Important thing on this one is it doesn't have to be a separate room. The home office doesn't have to be a separate room, but it does need to be separated in the sense that you only use it for business. It's exclusively used, that area is exclusively used for the rental business. It's not used in any other facets. For example, you're paying bills for the personal stuff, you're going to do that at the kitchen table. You're working on the rental stuff, you're going to go to your desk in your office. And that way you don't violate this rule. So that wraps it. 9 things that you need to know in 2026 for rental property. If you've got a tax question, feel free to reach out or comment below. And don't forget to like and subscribe. Appreciate your time.